Welcome to Thoughts on the Market. I'm Serena Tang, Morgan Stanley's Chief Cross-Asset Strategist.
And I'm Vishy Tirupattur, Morgan Stanley's Chief Fixed Income Strategist.
Today's topic, pushback to our outlook. It's Friday, June 6th at 10 a.m. in New York. Morgan Stanley Research published our midyear outlook about 2 weeks ago, a collaborative effort across the department, bringing together our economist views with our strategists' high-conviction ideas. Right now, we're recommending investors to be overweight in U.S. equities, overweight in core fixed income, like U.S. Treasuries, like U.S. IG corporate credit. But some of our views are out of consensus. So I want to talk to you, Vishy, about pushback that you've been getting and how we push back on the pushback.
Right. So the biggest pushback I've gotten is a bit of a dissonance between our economics narrative and our markets narrative. Our economics narrative, as you know, calls for a significant weakening of economic growth from about, for the US, 2.5% growth in 2024 goes into 1% in 2025 and in 2026. And Fed doesn't cut rates in 2025 and cuts 7 times in 2026. And if you look at a somewhat uninspiring outlook for the US economy from our economists, reconciling an uninspiring economic outlook on the US economy with the constructive view we have on US assets, equities, credit, treasuries, that's been a source of contention. So reconciling an uninspiring outlook on the US economy with a constructive view on risk assets as well as risk-free assets in the US economy, so equities, credit, as well as government bonds, has been a somewhat contentious issue. So how do we reconcile this? So my pushback to the pushback is the following, that there are different plot lines across different asset classes. So our economists have slowing of the economy, but not an outright recession. Our economists don't have rate cuts in 2025, but have 7 rate cuts in 2026. So if you look at the total number of rate cuts that are being priced in by the markets today, roughly about 2 rate cuts in 25 and about between 2 and 3 rate cuts in 2026, we expect greater policy easing than what's currently priced in the markets. So that makes sense for our constructive view on interest rates and in government bonds and duration. That makes sense. From a credit point of view, we enter this point with a much better credit fundamentals in leverage and coverage terms. We have the emergence of a total yield-based buyer base, which we think will be largely intact at our expectations. And you layer on top of that the idea that growth slows but doesn't fall into recession is also constructive for higher quality credit. So that explains our credit view. From an equities view, the drawdowns that we experienced in April, our equity strategists think marks the worst outcomes from a policy point of view that we could have had. That has already happened. So looking forward, they look for EPS growth over the course of the next 12 months. They look for benefits of deregulation to kick in. So along with that, 7 rate cuts get them to be comfortable in being constructive about their views on equities. So all of that ties together.
And I think what you mentioned around macro not being the markets is important here. Because when we did some analysis on historical periods where you had low growth and low inflation, actually in that kind of a scenario, equities did fine and corporate credit did fine. But also in an environment where you have rather unencouraging growth, that tends to map onto a slightly risk-off scenario. And historically, that's also a kind of backdrop where you see the dollar strengthen. This time out, we have a very out of consensus view. Not that the dollar will weaken, that seems quite consensus, but the degree and magnitude of dollar weakening. Where have you been getting the most pushback on our expectations for the dollar to depreciate by around 9% from here?
So the dollar weakness in itself is not out of consensus, largely driven by narrowing of rate differentials, growth differentials. I think some of the difference between the extent of weakness that we are projecting comes from the assessment on the policy uncertainty. So the policy uncertainty adds a greater degree of risk premium for taking on US assets. So in our forecast, we take into account not only the differentials in rates and growth, but also in the policy uncertainty and the risk premia that the investors would demand in the face of that kind of policy uncertainty. And that really explains why we are probably more negative on the outcome for US dollar than perhaps our competition.
The risk premium part, I think, bring us to one of the biggest debate we've been having with investors over not just the last few weeks, but over the last few months. And that is on US exceptionalism. Now, clearly, we have a view that U.S. assets can outperform over the next 6 to 12 months. But why aren't we factoring in higher risk premium for holding any kind of U.S. assets? Why should U.S. assets still do well?
So, as I said earlier, we are calling for the economy to slow without tipping into recession. We're also calling for greater amount of policy easing than what is currently priced in the markets. Both those factors are constructive. So I think we also should keep in mind the sheer size of the US markets. The US government bond markets, for example, are 10 times the size of comparably rated European bond markets, government bond markets put together. The US equity markets is 4 or 5 times the size of the European equity markets. Same thing for investment grade corporate credit bonds. The market is many, many times larger. So the sheer size of the US assets makes it very difficult for a globally diversified portfolio to substantially under-allocate to US assets. So what we are suggesting, therefore, is that allocate to US assets where there are all these opportunities we described. But if you're not a US investor, hedge the currency risk. Not hedging currency risk had worked in the past, but we are now saying hedge your currency risk.
And the market size and liquidity point is interesting. I think after the outlook was published, we had a lot of questions on this. And I think it's underappreciated how about sort of 60% of liquid, high-quality fixed income paper is actually denominated in US dollars. So at the end of the day, or at least over the next 6 to 12 months, it does seem like there is no alternative. Now, Vishy, we've talked a lot about where we're getting pushback. I think that one part of the outlook where very little discussed because very highly consensus is credit. And the consensus is credit is boring. So how do you see corporate credit and maybe securitized credit fit into the wider allocation views on fixed income?
Boring is good for a fixed income investor perspective, Serena. Our expectation of rate cuts, slowing growth, but not tipping into recession, and our idea that these spreads are really not going very far from where they are now, gets us to a total return of about over 10% for investment grade corporate credit. And that actually is a pretty good outcome for credit investors, for fixed income investors in general, that calls for continued allocations to high quality credit in corporate credit as well as in securitized credit.
So just to sum up, Morgan Stanley Research has very differentiated view this time around on how many times the Fed can cut, which is a lot more than what markets are pricing in at the moment, how much yields can fall, and also how much weakening in the US dollar that we can get. We are recommending investors to be overweight US equities and overweight US core fixed income like US Treasuries and like US IG corporate credit. And as much as we're not arguing that US exceptionalism can continue on forever, over the next 6 to 12 months, we are constructive on US assets. That is not to say policy uncertainty won't still create bouts of volatility over the next 12 months. But it does mean that during those scenarios, you want to sell US dollars rather than US assets. Vishy, thank you so much for taking the time to talk.
Great speaking with you, Serena.
And for those tuned in, thanks for listening. If you enjoy Thoughts on the Market, please leave us a review wherever you listen and share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.